Hey guys, in this video, I will introduce 4 recession-resistant stocks with a fortress balance sheet. Not only are they COVID-19 resilient, meaning that the negative impact of the coronavirus outbreak to their income is likely marginal or even be positive, but they will also continue to strive after this whole health pandemic issue is over by gaining market share over their cash-strapped peers. With a recession being imminent, or perhaps we are already in one, many companies will be in a challenging position in 2020. According to the data from Refinitiv, 40 S&P 500 companies have already reported their first quarter 2020 results as of 16 April. The actual year-on-year earnings growth thus far was negative 30.9%. On a full year 2020 basis, the current street forecast is for year-on-year earnings to decline by 12.8% as of now. I expect changes to be pretty fluid because 1 week ago it was at negative 8%, so potentially moving forward, there could be more downside bias to earnings revision for the whole of 2020. Take a look at Johnson & Johnson. The company slashed its full year earnings by 14% due to coronavirus. Note that Johnson & Johnson is supposed to be a defensive pharmaceutical company. If such a defensive company is to see its full year's earnings declining by negative 14%, I can't really imagine other companies doing significantly better than Johnson & Johnson in the current recessionary climate. There is thus a significant downside risk to the current 12.8% full year earnings decline as forecasted by the market. During an economic downturn that could potentially rival the Great Depressions of the 1930s, investors should look to blue chip stocks to weather the storm. However, not all blue chips will excel in the current climate. What you should be looking out for are companies with, number 1, a strong business model that is enduring, number 2, healthy cash flow generation, and number 3, a rock-solid balance sheet that often has more cash than debt. Let's take a look at some of these well-fortified blue chips that should be in the current watch list of all investors. So for stock number 1, no prizes for guessing, that is Amazon, sitting right at the top of our list. The company is the go-to resource for a huge proportion of the world's population currently under varying degrees of lockdown. While many brick-and-mortar retailers are shuttered, retailers such as JCPenney missing its bond interest, Macy will furlough the majority of its 125,000 employees, etc. Amazon just hired 100,000 workers in March and looks to hire an additional 75,000 workers in the coming months to cope with brisker business. The durability of Amazon's business model is no longer in question. The company has very interesting dynamics that in the near term will dramatically change how investors perceive the company. Amazon breaks down its business into 3 segments. Number 1, North America, number 2, International, and number 3, Amazon Web Services, or AWS for short. The first 2 of these segments, North America and International, refers to geographical breakdowns of Amazon's retail business. Retail can then be further broken down into online stores and physical stores. Despite the strong growth in retail sales, it is not where the company historically generates the bulk of its operating income. That honor belongs to AWS. AWS provides the company with more than $9.2 billion in operating profits for 2019. Comparatively, retail only generates $5.4 billion. The tide might have shifted in the current context, with Amazon benefiting strongly from the elevated volume in its online retail business and a progressive shift towards digital retail. As the health pandemic issues recedes over the coming months, Amazon might find itself as a prime beneficiary of a world population that is so much more accustomed to digital shopping. Who knows how many physical retail malls will be left standing after the crisis? The company is probably the dream of every investor right now, one that generates enormous profits in a bull market and in times of crisis like this one, ensures that these profits do not fade away as the rest of the market crumbles. Amazon generates tons of cash, and that is the company's key selling point. Net cash from operations increased from 3.9 billion in 2011 to 38.9 billion in 2019, or tenfold increase. During this period, Amazon's market cap increased at an approximate rate of 30% CAGR, from 112 billion to 920 billion. At 112 billion market cap generating 3.9 billion in operating cash, Amazon is valued at approximately 29 times price to operating cash flow. At 920 billion market cap generating 38.5 billion in operating cash, Amazon is valued at approximately 24 times price to operating cash flow. With the recent rise in share price, Amazon is now valued at almost 1.15 trillion in market cap. If I'm to assume that operating cash flow can grow at a rate of 30% in 2020, that would translate to full-year operating cash of close to 50 billion. At an average multiple of 26.5 times price to operating cash flow, that could imply a fair value of at least 1.3 trillion for Amazon. Not only is the company highly cash flow positive, it is also in an enviable position where the company is only marginally in a net debt position. With an equity of 62 billion, net debt to equity is a very manageable 13%. All in all, a fantastic company to own, one that is highly COVID resilient. An investor might want to keep the counter in your radar and purchase the stocks on dips. For the second recession-resistant stock with a fortress balance sheet, we have Electronic Arts. Electronic Arts is the software publisher behind blockbuster franchises such as FIFA and Star Wars. As a gaming company, this is another stock that will benefit from the current COVID-driven stay-home trend. As the government begins to encourage social distancing to slow the spread of the coronavirus, the video game industry could see some near-term benefits. The video game industry is rather uniquely positioned to see very little disruptions over the next 12 months. Video games could see increased engagement as folks fight off cabin fever. Online gaming often includes voice chat, and friends can therefore keep in touch and hang out virtually amid self-quarantines. At the same time, both Microsoft and Sony have announced their next-generation consoles, which are still to be scheduled to be launched in late 2020. Historically, the start of video game console cycles, which occur every 5 to 8 years, are positive for game publishers' stock returns. There is, however, the risk of game schedules being delayed, and the new consoles from Microsoft and Sony may likewise suffer issues from a prolonged disruption. Already, Sony just announced that it plans to produce far fewer units of its upcoming PlayStation 5 in its first year, 2020. To be honest, all three video game software publishers, Electronic Arts, Activision Blizzard, and Take-Two Interactive, are strong cash-generating entities. For Electronic Arts especially, cash generation has been extremely strong, with its free cash flow increasing from a mere 92 million in 2011 to 1.76 billion in 2019. With a market cap of 32 billion, the company is trading at an attractive price to free cash flow multiple of 18.2 times. This is at the lower range of its 5 years price to free cash flow band of between 15 times and 38 times. Meanwhile, Electronic Arts' strong balance sheet, which includes 5.6 billion in cash and only 1.1 billion in total debt, places the company in a strong net cash position of 4.5 billion, which is approximately 14% of its market cap. This is almost as good as it gets. Even if there might be a delay in the launch of the new consoles from Microsoft and Sony, slated for the end of the year, Electronic Arts, as a cash-generating machine, is well positioned to manage any troubles that comes its way. So for the third recession-resistant stock with a fortress balance sheet, we have Costco. During the coronavirus pandemic, it has become clear that a few companies remain essential no matter what is happening in the world. One of them has got to be Costco, the warehouse winner that sells products in bulk. It's obvious why people flock to the bulk discount chain in a pandemic. People want to buy everything in bulk and everything at a discount. These products are sold at everyday low prices in very large stores that lend themselves to social distancing. The company reported EPS of $2.10 for its fiscal second quarter ended February, with a beat fueled by panic buying due to COVID fears. The company also recently announced a spike in March sales to $15.5 billion, up 11.7% from a year ago period. Its e-commerce sales climbed 48.3% as more people around the world turn to online shopping. There are, however, concerns that sales will taper off after the crisis. No doubt, the current bump in sales might be a 1 or 2 quarters event. However, even after the coronavirus passes, Costco's low prices will remain extremely appealing, especially in an economy where the unemployment rates could be driven up as high as 20 to 30% in a worst case scenario. People will be clamoring for discount items, and that is what makes discount stores such as Costco so much more appealing even after this health crisis wanes. Costco generates plenty of free cash flow, to the tune of $3.3 billion in fiscal year 2019. While not exactly as attractive as Electronic Arts when we view it in terms of price to free cash flow, the counter's price to free cash flow multiple of 33 times is still at the lower range of its 5-year band of between 19 to 100 plus times. The counter also has a pristine balance sheet where it is in a slight net cash position, which is why I favor it over retail heavyweight Walmart that has a net debt position of over $61 billion. This allows Costco to maintain its track record of dividend hikes since 2005. The company on Wednesday declared a hike of almost 8% in its quarterly dividend. The new amount of 70 cents per share will be handed out on May 15 to investors of record as of 1st May. While not exactly a high-yielding counter, whereby right now the yield is still less than 1% even after the hike, this is one dividend growth stock that investors should keep an eye out for during this recessionary period, one which is likely to outperform the general market both in terms of share price performance and earnings expectations. So for the fourth recession-resistant stock with a fortress balance sheet, we have Vertex Pharmaceutical. Vertex Pharmaceutical is a stock that is largely immune to the ravages of the coronavirus because the company is focused solely on the development of pharmaceuticals to treat serious diseases such as cystic fibrosis. It also has a pipeline of products for kidney diseases, sickle cell anemia, and other ailments. The company is currently enjoying a trifecta of number 1, high growth, number 2, long patent life, and number 3, a major pipeline of catalysts in 2020. Shares of the company jumped in January when the company reported sales of its new cystic fibrosis therapy that vastly outpaced analyst expectations. Cystic fibrosis is a progressive genetic disease that affects various organs, but is most known for its effect on the lungs. Morningstar predicts sales of its cystic fibrosis drugs will hit $5.3 billion this year and may contribute more than $10 billion to revenue in 2028. At $5.3 billion in sales for 2020, that represents a year-on-year growth of 26%. Some people might be concerned about Vertex supply chain disruption. However, the company recently said that the pandemic hasn't impacted its supply chain or its business outlook for the year. Nonetheless, new clinical studies might be delayed as many hospitals that serve as trial sites are currently overwhelmed with coronavirus patients. The company is one of the few pharmaceutical companies that generate a ton of free cash flow, 1.5 billion to be exact in 2019. Consequently, it has also built up a strong balance sheet with a net cash position of 3.3 billion or 5% of its market cap. Shares are trading at a near record high after gaining close to 20% year to date. Over the short term, this counter will likely be seen as a safe haven and highly recessionary proof. In the long term, its new family of cystic fibrosis drugs, some in their early days such as Trikafta, will ensure that Vertex revenue and earnings continue to climb. This is one pharmaceutical stock that could join the 100 billion market cap club category sooner rather than later. In conclusion, these four stocks are mostly trading at 52 weeks high, even in today's context, which is pretty commendable. Out of the four stocks, Costco might potentially see some short-term pullback when the virus ebbs, as the market views the spike in near-term grocery buying as over. Nonetheless, Costco is one of the very few stocks that has done extremely well, both during good and bad times, due to its unique positioning as a bulk purchase discount store with an extremely high level of membership renewal rate. Do take a look at these stocks and do your own due diligence to see if they are potential candidates for your portfolio. These four recession-resistant stocks with fortress balance sheets are part of my shopping list of blue chips stocks to buy when the opportunity presents itself. With that, we have come to the end of the video. Do smash the like button and subscribe to my channel. With that, this is Royston signing out.